HMRC is launching a massive crypto crackdown, and they know every single trade that you've made. So if you traded crypto in the last 6 years and you haven't declared it, I'd certainly suggest you watch every second of this video, because what I'm about to tell you could be the difference between sorting this mess out yourself and having HMRC try and destroy your finances with penalties, interest, and potentially legal action that could leave lasting consequences. To be absolutely honest with you, I'm astounded at what's happening here. And I think that you really should be too, because for years, the government has completely ignored crypto. They sat there on their hands while we took the risks, we did the research, invested our hard-earned money. They gave us zero guidance, zero support, and zero clarity on the rules. Now, suddenly, when people have made some gains, they want their pound of flesh. They're treating everyday investors like tax dodgers, like criminals. So I'm here to fight back with you, to expose their dirty tactics, show you exactly what HMRC actually knows, how they know it, and most importantly, what you need to do to protect yourself before it's too late. So for those of you that remember the early days, and I'm talking kind of really 2016, 17, even 2020, it felt like a financial Wild West. Things were decentralized, free from government interference. We were told that crypto was different. It was beyond their reach, outside the system. Now, those days are dead and buried. While we were all focused on celebrating our gains and building out our portfolios, HMRC was playing the long game. They were quietly building a surveillance network that would probably make Big Brother jealous. They first came with a soft approach, the innocent-looking question on the tax return. Have you received or disposed of any crypto? Seems harmless, right? That's wrong, because it's a trap. Now, if you tick no, and they catch you, and they find out you've actually been trading, well, congratulations, you just made a false declaration, and that one little tick has taken you from, I made an honest mistake, to, oh, now this is deliberate tax evasion. And that's in their eyes. The penalties, well, they just doubled. But the question was just an appetizer. Now is the main course. And what they're doing, trust me, is going to give you a bit more serious indigestion. Because they've gone from ignoring crypto to building out a massive machine that is designed to catch every single person who's made a gain and hasn't declared it. And they do want everyone. So let me spell out exactly what HMRC knows about your crypto. Now, this might shock you, but since 2024, the UK exchanges have been forced to hand over customer data whenever HMRC demands it. And guess what? They demand it a lot. Now, we're talking your full legal name, home address, every single wallet address that you've ever used, complete transactional history going back years, the value of every trade, transfer, every transaction. So even cases where it's not even a UK exchange, HMRC has information sharing agreements with those exchanges worldwide. Even the sketchy ones that you thought were anonymous, they're even caving under international pressures. So here's where it gets kind of terrifying, because from January 2026, the Crypto Asset Reporting Framework goes live, CARF, as they call it. Now, that Q acronym, something that is really about to destroy financial privacy forever. Under CARF, every exchange in over 50 countries will automatically share your data with HMRC. Now, there's no warrant needed, there's no suspicion required, no request necessary, just a constant stream of your financial data flowing straight to the taxman. That's every trade, every swap, every transfer, all reported automatically. And it's not just exchanges. Now, HMRC has spent over 100 million building an AI system that they call Connect. This is a digital bloodhound, and it matches your crypto transactions to your tax returns. It also scans your bank account statements for any kind of transfers to exchanges. It monitors social media posts about crypto gains. It tracks luxury purchases that don't match your declared income. And it can even analyze your LinkedIn for job changes that might affect your tax rate. So if you've, let's say, posted about sick gains on X, Connect will see that. If you've transferred money from your Barclays account to your Binance, Connect will see it. If you bought a Tesla but not declared any crypto gains, well, Connect will definitely see that. They're not guessing anymore. They're not fishing. They bloody know. So you might be thinking, this is actually something I need to worry about. That's exactly why I've created something to give you a bit more clarity. It's a simple questionnaire that tells you in under a couple of minutes, really, whether you need to report to HMRC. It is free, it's anonymous, and it really could save you from a world of pain. The link's in the description below. You can pause this video and do it now while it's fresh in your mind, because what I'm kind of about to go into next about taxable events, it might have you breaking out in a bit of a cold sweat. Right, let's get into the meat of what HMRC considers taxable. And you have to sit back and brace yourself, because they made practically everything a tax event. So obviously, selling crypto for pound sterling is taxable. You cash out your Bitcoin to your bank account, they want their cut. But that's just the start. Here's where they really start to take the mick, because if you're swapping crypto for another, that's taxable. That Bitcoin to Ethereum swap you did in HMRC's eyes, you sold Bitcoin and you bought Ethereum. It doesn't matter that you never ultimately touch those pounds. They want their cut. Every single swap counts. Now, moving on, spending crypto, that's also taxable. If you bought a pizza with Bitcoin, congratulations, you just created a taxable event. If you pay for a VPN with crypto, that's taxable. If you bought an NFT, taxable. And yes, they seriously expect you to calculate that gain from when you bought Bitcoin to when you bought that overpriced margarita. If you're gifting crypto, that's also taxable, unless it is to your spouse. Let's say, you want to give your kid or a mate some Bitcoin for their birthday. HMRC says you dispose of that at market value. So giving away, let's say, a K of Bitcoin, they tax it as you sold it at a K. And so you're basically going to be taxed on your generosity now. You couldn't make it up. But, I can go on here to like staking rewards, taxable as income when you receive, and then taxable again as you sold it on capital gains. Airdrops, taxable as income. Mining, you guessed it, is taxable as income. Even moving crypto between your own wallets can trigger the algorithms if you're not careful. So it's important to have your documentation. If you want more bad news, you only get a measly £3,000 tax-free allowance. That's it. Now, the number of people who think, well, I haven't cashed out, from a bank, so I'm fine. It's staggering and it's wrong, ultimately, that. Every swap, every purchase, every transfer that's not between your own wallets, it all counts. Now, let me warn you about one of HMRC's sneakiest trap, and this is called the bread and breakfasting rule. And no, it's got nothing to do with a lovely weekend by the coast. This rule is specifically designed to stop you from being smart with your taxes, and it catches out so many crypto traders. Here's what happens. The market dumps, your portfolio is red, and you think, I'll sell at a loss, use it to reduce my tax bill, then buy back immediately. Now that makes sense, right? You lock in the loss for tax purposes while keeping your position. That's wrong. HMRC is well ahead of you. Under the 30-day rule, if you repurchase the same crypto within that 30-day period of selling it, the disposer gets special treatment. It doesn't use your original cost base from your Section 104 pool. Instead, it matches directly to your new purchase. An example, you bought Ethereum for $5,000 back in 2021. The market crashes, it's now worth $3,000. You're sitting on a £2,000 loss. You then sell it $3,000, and 10 days later, you buy back the same amount for $3,100. HMRC matches your disposal to that $3,100 purchase, not the original 5K cost. So your loss just shrank from $2,000 to a crazy £100. That's $1,900 of legitimate losses just gone. The rule works both ways as well. If you sell high and rebuy low within 30 days, you might accidentally increase your taxable gain. If you're day trading, swing trading, or using bots, you might trigger this rule a dozen times without even realizing it. Each violation compounds the problem, and your tax calculation becomes a bloody nightmare. So if you want to avoid this trap, there are three options you have. You can either wait 31 days before rebuying. Good luck with that in a volatile market. You buy different crypto, you're changing your position, or you can use your spouse to transfer, for the tax-free allowance. So you can sell while the other buys. But if you mess this up, HMRC will recalculate everything, and they will always do it in their favor. Now, here's a question that I get regularly. Should I hold crypto in my limited company? Surely it's more tax efficient, right? Every kind of crypto WhatsApp group has that one guy who swears blind you should trade through your limited. Now, let me burst that bubble right now with some cold, hard facts, because it is an absolute killer. Companies get zero capital gains allowance. Now, while we get $3,000, it's not a lot tax-free. Companies pay corporation tax on every penny of profit from day one. Now, that's 19% on small profits, 25% if you're making serious gains. What you got to think about is the double taxation hammer here, and that's what causes the issues. Now, if you want to take the profits out of the company, that's dividend tax we have to think about. Now, those rates start at 8.75% at basic, and it goes to 33.75 up to 39.35. Now, if you do the maths, let's say your company pays 90% corporation tax and you pay 33.75% dividend tax. The total tax you then paid is 45%. If your company pays 25% corp tax and the high dividend as well rate, then that's 54%. Now, if you compare that to your personal ownership, we have that first 3K at basic rate, 18K or then 24%, but there's no double taxation. It's not as complex, there's no dividend tax. And ultimately, if you're thinking, oh, but what about the expenses side? Now, if you're genuinely trading as a crypto business, which HMRC has a very high bar for, you might get away with it. But buying and holding is not a business. Occasional trading is not a business. Even frequent trading isn't a business unless it's your full-time job. You need business-like organization with like sophisticated trading strategies and a significant time commitment. And most people just don't qualify. And nobody really tells you about, the company crypto headaches. It is more of an accountancy nightmare. Every transaction needs bookkeeping, fees, kind of eat up tax savings. There's locked in funds because, getting that crypto out, as I just kind of spoke about, it is taxable. Then there's compliance costs, things like mortgage, for yourself. Many lenders aren't going to accept dividend income like they would do employment income. So the only times ownership might work is if you are actually building out a crypto business. If you're never really planning to extract those profits, you're trading, let's say, millions with a proper infrastructure. You've got other business activities to offset losses. But I would say probably for 99% of people, especially watching this, just keep it personal. Use your allowances, keep it simple, and don't let anyone else convince you otherwise. So now let's talk some real numbers, because this is where HMRC kind of twists the knife. Once you do exceed that 3,000, pathetic personal allowance, the damage then starts because, you as a taxpayer will pay 18% on gains. As I already said, the higher rate is 24%. But the crypto gains stack on top of your regular income. So, to determine that kind of tax band, if you earn 45K, let's say for your day job, you make 10K profit on crypto, your total income is now 55,000. So that crypto gain isn't taxed at 18%, it's taxed at 24%. That's an extra £600 gone. And the calculation itself, it is deliberately kind of infuriatingly complex. The Section 104 pool means that you can't choose which coins you're selling. Everything gets averaged. So if you bought one Bitcoin for 5,000 and another Bitcoin for 50,000, your average cost is 27,500, right? So selling one Bitcoin for 30,000 and your gain is 2,500, not the loss that you might have expected. So let me give you a hypothetical example. Sarah made 15,000 profit on crypto this year. Minus her 3,000 personal allowance equals 12K taxable, but she earns 35K from her job. Basic pay is 18%. So that's 2,160. But part of the gain pushes her over into the 50K. So that's a 24% threshold. Her final bill is 2,400. So, she's had to pay quite a lot of tax for the audacity of being a successful low-key investor. Now, when HMRC catches you with these new powers, and it is when, it's not, if, they're going to try and systematically destroy you. So the stage one is that note letter, we believe you have undeclared crypto gains. The translation to that is, we know you've been trading, we have the data, it's your one chance to come clean. Then stage two is that formal investigation. If you've ignored the nudge letter, well, now comes a formal inquiry. They will demand complete bank statements, exchange records, wallet addresses and private keys, explanations for basically every transaction. They will spend months going through your financial life. The third stage really is the assessment, and they will calculate what they think you owe, and they will always overestimate their assumptions. They're just going to assume you're hiding more. Now, you have to prove them wrong. It's ultimately you're guilty until proven innocent. And stage four is the legal action. This is worst case, but county court judgments that can destroy your credit, charging orders, you could have frozen bank accounts, asset seizure. And yes, they do publish, like tax evasion names. And this is extreme, but the reality is your reputation could be destroyed, your finances could completely collapse, and God knows what your mental health is going to be like. Now, the penalties alone are specifically designed to be bloody painful. Now, it's up to 100% of unpaid tax. So let's just say you owe £10,000 in tax. That's now 20K. If you owe 50,000, well, I hope you got 100K. And interest at 7.5% compounded daily on that Bitcoin trade from 2017. That interest alone could just kill your bill. So HMRC can go back years if they do suspect deliberate concealment, and you could be paying for trades that, you did before your kids were even born. So enough doom and gloom for 1 minute. Here's your survival plan. Step one is to basically just do the questionnaire. Do it now. It's 2 minutes to know if you need to act. The link is in the description. Step two, if you do need to act, you need to gather everything. Exchange account, every wallet address, every transaction hash, every bank transfer to exchanges, even if you've got screenshots, CSVs, whatever it is you've got. And I do appreciate this is overwhelming, but it's far better than HMRC doing it and adding their BS penalties onto things. So the step three side is to calculate properly. Remember the breakfasting rule. Use the kind of proper tax calculators out there, there's software, and you can seek out professional help. It is worth every penny. Don't try and DIY it yourself with a spreadsheet. And the final thing, step 4, is that voluntary disclosure. If you go full to HMRC and say, look, I want to come clean, the penalties do drop. And if you're exceptionally lucky, they can drop to 0%. Now, step 5 is your legal strategies. Make sure you are transferring that tax-free allowance to things like your spouse. You need to make sure you watch that 30-day rule. Keep things personal. Step away from any limited company. You don't want to be going down that route. You want to fix it before the close of the tax year, which is the 5th of April. And that will kind of give you then time to make sure you can prepare, save, and any legal ways to try and reduce your tax bill. The final one is, if you need help, it is out there. If you're deep in it, get professional help. The cost of advice really is nothing compared to what the penalties could be with HMRC. So to bring things right back down, this isn't the only thing that HMRC is doing in 2026. If you're a sole trader, well, you're in for a real treat. HMRC are going to make you submit 5 returns a year. So maybe jump over to the video on your screen now and find out what's happening and what you need to do to fight back.